What's up, guys? Humphrey here. So the market has been rocky, to say the least, these past 2 weeks. Now, there have been many reasons for it, but one large part of it is the fact that bond yields are going up, leading to sell-offs in the stock market, especially in the tech and growth sectors. There's also Evergrande, supply chain issues, and inflation, among other things like the Facebook outage, but we'll talk about all this in today's video. So first, let's get into why bond yields affect almost everything in the economy. Let's dive into how bond yields work, and we'll also discuss some other factors contributing to the recent downturn in growth and tech stocks. Now, when we're talking about bond yields, traders are mostly referring to the 10-year Treasury note. It's one of the biggest indicators for how the US economy performs. A 10-year Treasury note is basically a security offered by the US government in order for them to raise money. So when you buy a Treasury note, you're essentially lending the government money. And for that loan, they basically pay you an interest rate until the bond actually comes due in 10 years. Now, one of the main reasons that people like them is they provide a lot of certainty during times of economic uncertainty. Now, the one thing you need to know is that the interest rates on bonds, like the 10-year Treasury note, influences interest rates everywhere. When there's a rise of yield on the 10-year Treasury note, for example, the cost of borrowing becomes more expensive for individuals and companies. So when that happens, it basically prompts a sell-off. But why is this the case, especially if the yield only rises from, say, 1.45% to 1.5% on the 10-year Treasury note? That doesn't seem that significant, or does it? To understand why a small change like that actually affects stocks, it actually has to come down to how stocks are actually calculated and valued. Stocks and companies are valued by their future cash flows, as in what can they generate in the future in terms of how much cash they actually bring in. Investors and traders like to discount the future cash flows of a company back to the present, which is basically a fancy way of asking ourselves, hey, what do we think the cash flows of this company are going to be worth to us today? It's one of the main valuation methods of any company's stock price. You figure out what the company is likely to generate in the future, value them at the present, and voila, you have a better sense of what the company's valuation and stock price should be on current day. It's kind of like the same phenomena you see when stocks trade higher after a certain piece of news is released. Let's say you are running a pharmaceutical company and your drug gets approved by the FDA. Well, the stock price will most likely skyrocket because the market is anticipating a lot of future sales of that drug. Now, even though that company is not producing any drugs as of present day, just the mere idea that this company can sell those drugs is going to drive up the stock price. Now, to calculate the present value of cash flows, you actually need something called the risk-free rate in order to discount the cash flows backwards. That risk-free rate is usually influenced by bond yields. So you see here, because bond yields are going up, they actually have an important role when calculating future cash flows. If bond yields go up, this impacts future cash flows inversely. Rising bond yields means that future cash flows are actually going to be worth less to us today. So if cash flows are worth less to us today because bond yields are up, it actually disproportionately affects the tech and growth sectors. A large part of the value of tech and growth stocks are driven by what revenue that they can actually drive in the future. All right, so I hope that made sense. So you actually might be wondering, okay, well, why are bond yields going up? And are they going to continue to go up? Well, let me rewind for just a quick second. Back in March of this year, bond yields were actually even higher than what they are today. So why was it that back in March, nothing really notable happened with the market and growth stocks? Why did they trade flat back then versus today? The bond yields are lower than that of March, but growth and tech sectors are being impacted so negatively. The main reason has to do with why the bond yields are up. You see, back in March, bond yields were up even closer to 1.75% for the 10-year Treasury note, but stocks were doing just fine because there was the prospect of economic recovery and no sign of tapering from the Fed. Now, if we fast forward to the present, this time around, there's this impending threat of inflation. And at the most recent Fed meeting, they signaled that there would be a tapering to slowly remove monetary stimulus in the economy as soon as November. So you combine this fact with the fact that other central banks in the world are looking to do the same thing, which is tighten their monetary policy. And in conjunction with that, we have inflation being accelerated in almost every single part of the world this year. Now, to even muddy the situation a little bit further, we even have supply chain issues arising as a result from COVID. So let's talk about the supply chain for a quick second because it also impacts how the market is reacting as of late. There's a great TikTok video from Kyla Scanlon which sums up the supply chain issues perfectly and how it relates to inflation. Right now, a lot of people are ordering goods, as in there's high demand for products and semiconductors, but there's not a lot of supply of these goods because the factories, the ports, and the ships had to shut down because of COVID. So what you have is a backlog of goods that needs to be delivered, yet demand is still increasing ahead of Q4. Not only that, you have shipping costs increasing over 229% in a given year. a labor shortage, and goods are just taking a really long time to ship to the United States and other developed countries. So all of this is leading to a perfect storm of even higher inflation. Now, if you'll remember from Economics 101, a surge in demand for products and services can cause inflation as consumers are willing to pay more for that same product. So what you see happening on a global scale is the usual problem of supply and demand. And I'm sure you can feel that in your own life as well. I'm sure that you've noticed prices of everyday things going up lately. In addition to the crazy used car market, the commodity market, hell, even the meat at the grocery store is more expensive. I know personally, I usually eat lunch out every day. It used to cost me less than $15 here in California, but these days it's inching closer to $20 per meal. Now, it's because of this surge in demand and threat of inflation that the Fed has signaled that they really want to increase the interest rates and pull back on the financial support. But in order to do that, they need to see substantial further progress on inflation and job growth before doing so. Now, there is a jobs report coming out this Friday, October the 8th. Now, that should be more of an indicator on how the Fed will react with their monetary policy, but already with the threat of pulling back monetary support, we're seeing it reflected in the bond yields and therefore negatively on the stock market. The key takeaway is that we should be keeping an eye on the 10-year Treasury yield in addition to what the Fed moves are going to be coming this month. Now, if we see rates go up, we could actually see more of a pullback on growth and tech stocks. Now, according to Wall Street Journal's article on bond yields, which I will link in the description below, it says, quote, given big tech's outsized share of the overall market, investors in the S&P 500 need to be convinced that if bond yields are going to keep rising, it'll be for a good reason of an accelerating economy, not the bad reason of sticky inflation pushing central banks to act. Essentially, bond yields rising with inflation is bad, but bond yields rising with accelerating economy is good. So is it always the case that if the bond yields move up, the stock market is going to go down? That's not necessarily the case either. Today is a great example of how the market is moving flat or upwards even as the 10-year Treasury note increases. This could be a temporary bounce back, or the Treasury yield just hasn't hit a psychological barrier to cause immediate disruption in the markets just yet. The next largest barrier is probably around 1.6% in my opinion, and then the one-year high of around 1.75%. There are some other things in the news that we should also pay attention to as well that I alluded to earlier. The Chinese Evergrande real estate company is still at risk of default, but as of yesterday, they are in talks to be acquired by another real estate developer called Hobson Development Holdings. If that happens, that would actually be one of the better cases for the troubled real estate developer and the markets, and I think that the entire saga of Evergrande might be behind us if that were to go through in a smooth manner. Now, if Evergrande were to implode on its own, then we could have probably seen the entire global market been affected, which hopefully won't be the case this time. Another issue causing a scare in the tech markets was Facebook's outage yesterday, so that actually prompted the stock to trade at 5% lower at the end of close yesterday. Now, Facebook stock has recovered a little bit today, but the whistleblower testimony at today's Senate hearing exposes a lot of internal weaknesses that Facebook is facing, including not doing enough on privacy and acting in the best interest of profit over mental health and safety. Lastly, the middle of October, October 18th, is an upcoming deadline. That's when the US government is set to run out of money. Now, stories like this have cropped up in the past. Government shutdowns are a pretty frequent occurrence, with the last one happening in early 2019. To give you a refresher, that was when Congress disagreed on Trump's border wall funding bill, and that lasted for 69 hours in late January 2019. And so, how did the market react back then? According to this article, when the market opened to a still shuttered government on the morning of Monday, January 22nd, stocks surprisingly rose 0.8%. Now, quote, while government shutdowns historically have had little impact on overall market performance, budget disagreements contrarily can have a profound effect. For example, following a bitter fight over the debt ceiling in 2011, the S&P index dropped 6.7% the following trading day. So how do we know if this debt ceiling disagreement in the middle of October is going to cause a ripple in the markets or not? So in doing my own research, there's been more than just a handful of debt ceiling crises in the past, and the truth is we don't really know what's going to happen. What usually happens is that the government passes a funding bill to fund the government and suspending any debt ceiling until a later time. In other words, they just kick the can down the road. We may see credit agencies reevaluate the creditworthiness of US debt, which could also cause a stir in the markets at that time. Now, personally, I haven't done enough historical research to know what's going to happen, so this is just an ongoing story that we're going to have to pay attention to. So what should you guys do in anticipation of all this uncertainty? Well, first off, interest rates are most likely going to go up in the next year or two. So if you are looking to make a big purchase like a home or maybe a new car, it might be a good idea to lock in a low interest rate now. Second, in terms of the stock market, if you feel that you're overexposed on tech and growth stocks, it might be a good time to rotate some of those holdings into more value stocks. And third, keep an eye on the US debt ceiling talks, as the looming government shutdown might be the catalyst for a market correction. I hope that you enjoyed today's video. As always, let me know any comments you might have below, and I'll see you guys in the next video, which will hopefully be in a couple days here.